Hello and welcome back to the Let's Talk Success podcast powered by Goba Capital. Goba is a specialty finance company that offers working capital lines of credit to mid-sized businesses. Today's topic centers around safeguard lending and the essential role of risk mitigation. We will explore the interconnected nature of risk management, insurance, and legal frameworks in modern today's lending and provide actionable strategies for mitigating financial and operational risks, while highlighting real-world examples of how lenders can proactively protect their portfolios. I'm your host, Cole Thompson, and I'm pleased to introduce our panel of participants. Sean Gajadhar with Goba Capital, he is an enterprise risk manager there. Todd Lynady, head of financial solutions, North America and multinational trade credit leader of the Americas at WTW, and Deanna Reitman, a partner at Faegre Drinker. Thank you all for being here. Let's get started with some brief introductions and backgrounds, shall we? Deanna, let's go ahead and start with you.
Thank you so much. It's great to be here. I appreciate it. So my name is Deanna Reitman, although everyone says Reitman, so that's fine, Cole. And I'm with Faegre Drinker. I am an energy, commodities, and derivatives lawyer. I focus on transactional matters and financial matters. So I'm pleased to be here with Sean and Todd and to talk about this topic today. Thanks for having me.
Thanks, Deanna. Sean, let's hear about your background and the work you do at Goba.
Yes, thank you, Cole. Hello, everyone. Hope everyone's doing great today. I'm thrilled to be part of this Goba podcast. I've been in banking approximately 24 years. I started my career in New York working for large multinational banks such as Citigroup and Nomura. In those roles at those institutions, I focused on several key aspects of risk management, and those were items such as operational resiliency, internal controls, and risk management. Then I moved to Miami about 10 years ago and I jumped into retail and commercial banking. I worked at Amerant Bank for about 9 years. But while the landscape was a little different coming from investment banking and sales and trading in New York, I think my goal was obviously always focused on, mitigating risk, implementing systems, controls, and processes to help protect the bottom line for the institution. After leaving Amerant Bank about a year ago, I joined Goba Capital. And at Goba Capital, I'm the enterprise risk manager. And the key things that I'm responsible for at Goba include compliance, fraud mitigation, operational resiliency, and insurance. And so far, it's been a great journey, and I look forward to being a part of this success story.
That's great, Sean. Thanks so much. And Todd, tell us about yourself, your background and role at WTW.
Thanks, Cole, and looking forward to speaking with everybody today. Yeah, so I've been with WTW for 2 years, and interestingly enough, after about 30 years in the business world, this is my first job as a broker. We are an insurance broker for credit and political risk insurance. The majority of my career, I've been on the underwriting side. I've worked with Atradius, I've worked with Zurich and Allianz Trade, which was formerly known as Euler Hermes. And I like to say I had 2 sabbaticals during my lifetime of insurance. I took a 3-year hiatus after Atradius, and I worked at GE Capital in their corporate lending group. And then right before I joined Willis, I worked as global head of insurance for a trade finance fintech called Liquidex. So looking forward to talking to you guys today and hopefully offering some perspective to your listeners.
Wonderful. We have an all-star cast with us today. Thank you again for joining. Let's start with the insurance side of risk management. Todd, why is insurance a non-negotiable aspect of lending, and what are the biggest risks lenders face without it?
Yeah, especially in North America, but I think you see this globally. You're seeing growing recognition that credit insurance is more than just a risk tool, but more of a strategic tool for the operational aspects, risk aspects, and if you're outside of the US, the capital relief functions that you're able to get out of using trade credit insurance as risk substitution. So when you bring that all together, you see banks getting a greater capacity for lending, offering greater lines, and a little bit more comfort in that aspect. So when you look at, the mid-market to, the large cap market, you see credit insurance offers a way for the banks to increase their appetite, but also grants these corporates a good ability to leverage the insurance more than they've had in the past. when you look at it, there's different reasons why banks will use this. Some use it for their internal concentration limits. But then in some credit facilities, banks will actually place a concentration limit on specific debtors or specific countries. And with credit insurance, the banks are able to lift that covenant, which is then just a lot less friction in that transaction aspect of it, but also puts the bank at a competitive advantage against some of their peers that might be continuing to keep those covenants a little bit more tight. So we've seen a number of examples where the use of credit insurance has allowed banks to, not only increase their hold levels, participate in deals that they might not have historically, and just really bring more flexibility and creativity to the market.
Yeah, certainly. We're seeing the banks compete with some of the alternative and non-bank groups as it pertains to risk insured or insured receivable lending. So yeah, definitely seeing that from a direct lending standpoint. Sean, from an enterprise risk perspective, how do you integrate insurance into a broader risk strategy for lending operations?
Thank you, Cole. Just to piggyback off of what Todd was saying, I definitely agree. I think insurance gives us the ability to have a bigger risk appetite and to provide the liquidity that our clients are seeking. So while insurance, it's a necessary tool, obviously, on the credit side, to protect the portfolio, depending on, the clients, the nature of the facility, the geographic location, it's becoming increasingly necessary to add that layer of protection, to our lending activities. And so whether it's a factoring deal, supply chain finance, or, PO financing, really the goal is to have that added layer of protection and to mitigate, right? And I think, considering kind of like the global economic conditions right now with tariffs and kind of other things that are going on, it becomes increasingly important, to have, that protection. And so I think it's important. I think it's a necessity these days, if you ask me. And I think it grants Goba the ability to go out there and take a little more risk than we, would have wanted to take, assuming we don't have it. Now, that being said, I just want to add that insurance is not obviously the only criteria into doing a deal, right? We'd like to have it, but it's not always a requirement. But definitely having it in place, I think, obviously makes us, gives us a little more comfort and, puts us into just a better overall position to take that risk.
Certainly, I would agree. Dina, while insurance is key, legal contracts are equally as important. What are some of the most essential legal safeguards that lending contracts should include to minimize risk?
Thank you for saying that legal is important. I appreciate that because it is important. And there are some key provisions in the agreement that we can put in place to minimize risk, right? So one of them is ensuring that your collateral and security interests are protected. And for those that don't know what those provisions are, it's where it provides the lender the right to seize specific assets if the borrower defaults. So, for example, the provision would read something along the lines of, the borrower hereby grants the lender a first priority security interest in all present and future accounts receivable, inventory, and equipment as collateral for the loan, for example. That's a great protection, and that's one. Another is putting a guarantee inside of the agreement, right? So a guarantee, for those that don't know what it is third party, not a party to the agreement, but a third party is liable for the debt of the borrower if the borrower defaults. So, for example, this provision would read like John Doe as guarantor, quote unquote, hereby unconditionally guarantees the full and prompt payment and performance of all obligations of the borrower under this loan or this credit facility, what have you, right? And this way, if they default, the lender may pursue the guarantor for repayment. Right? There are also covenants inside of an agreement which are very important, right? So covenants are both positive and negative. Positive meaning actions you must take, negative meaning actions you cannot take. So, for example, of a positive covenant, just to feed upon and build upon what Todd and Sean were already saying, borrower must maintain blank amount of insurance, right? That's a positive covenant that also protects the lender. So negative covenant is the opposite, right? So it's a restriction on the borrower. So just for example, the borrower shall not incur any additional indebtedness, right, over a certain dollar amount. That also protects the lender. There's specific language you can put into contracts with regards to events of default and acceleration clauses, interest rate provisions, repayment terms. The list goes on and on and on and on. Subordination clauses, financial ratios and matrices. But just rather quickly, because I don't think I have enough time to go through it all, I just want to say that in the event of default section, right, you can specify certain things that trigger the default and allow a lender to take certain actions, right? And obviously, some of the most common ones are missed payments. But what you can also put in there is like financial ratio breaches. Todd shaking his head. I know you guys can't see all this, but if there's you're supposed to have a certain ratio of debt to asset, for example. If that becomes a breach, then the lender is able to take action on that. So the default provisions can be more than just simply missing payment. And again, the list goes on, but those are some of the most essential, Cole.
Thanks, Dina. Yeah, those are some great points. And I think layering on the legal aspect to this podcast is extremely helpful, and it provides good color into the total kind of complete legal safeguard or lending safeguard, if you will. Todd, how are insurance policies typically structured? Are you going off of the kind of the legal contracts that Dina just kind of explained, or are you looking at the letter of intent from the borrower? Where is your starting point to kind of craft the overall policy and coverage?
Yeah, this is a very important aspect because the policy itself has to be properly aligned with the actual credit facility agreement, regardless of whatever it is. And if that's not the case, the operational risk that the bank then faces as it relates to a claim potentially being denied is huge. So if the insured event falls outside any of the agreed definitions, as Deanna just mentioned, or if the triggers don't match up, where the trigger on the one aspect of the facility doesn't match up with the policy, that could also be a situation where you have two different legal documents, the credit facility and the insurance policy, that are not aligned in terms of how they're supposed to respond. Now, what I'm talking about here, and I think this is very important, this is when the bank is the insured, right? It's a little different when there's a corporate as the insured with a bank as loss payee. That's different. We do similar analysis there, but it's not as rigid, I would say, just because of the nature of the funding itself. But like, regardless of what you're looking at, if it's a portfolio of accounts receivables under a credit insurance program or a single project finance deal, right? You have to look at each, or an ABL deal, as I just mentioned, each of the policies, each of the obligations of all parties are very different. The triggers are different. The timeframes are different. Everything is different. So, as a borrower, as a bank, anyone who's going to utilize insurance, you really need to look into your partner, your broker, and the underwriter to ensure that the wording itself is bespoke to the transaction, but also is fully synchronized with the finance documentation. That is critical for insurance to properly respond. And going back to the covenants or repayment schedules or any sort of default clauses, all of that has to map into the insurance policy to make them congruent with the facility, the terms and the definitions in the facility. And it's really interesting because when I was an underwriter, we would get to the 10-yard line and some of our brokers would like, oh, let's talk about legals now. Let's talk about the wording. Here at WTW, we do the exact opposite. We are, from the get-go, we want to talk with our client's legal team to ensure that the wording that we're working on with the insurer is consistent with the financing document. Because with that, there's a lot of time wasted. There's a lot of money wasted. And I've seen deals fall apart literally at the last minute due to that inconsistent view of how the policy should read versus the financing agreement reads versus what's going to work for the underwriter.
Yeah, and we've seen those deals fall apart at the 11th hour too. So understood that it's crucial when it comes from structuring the credit to getting the right legal docs in place through the help of an attorney like Dina and making sure that we have the right carrier or broker who can thoroughly understand those concepts and prepare the right coverage that corresponds to those business points. Dina, what are some key covenants that can help a lender enforce the credit agreement?
Yes, so I know we talked about some of the provisions of a credit facility before, but there are some things that we didn't talk about before, and they're very important to ensure that the borrower is held accountable. And one of those is the reps and warranty section of the credit facility and the loan agreement, right? So the reps and warranty section, they play a crucial role to ensure that the borrower is accountable in this loan agreement, and they establish clear and upfront assurances about the borrower's condition and the circumstances around which the lender is providing the loan, right? So some of the reps and warranties that are very important is, there has to be a verification of the financial condition of the borrower, right? And so you can have a rep and warranty that require the borrower to provide accurate information about their financial status and their business operations. Seems pretty simple, but that's an important rep, right? Because if they don't provide accurate information, it's then a breach of the agreement and the lender can terminate and or accelerate, right, etc. Another really important rep and warranty to make sure that the borrower is held accountable is, again, sounds super duper simple, but you have a rep and warranty that the borrower confirms that they're in compliance with all laws, rules, and regulations, right? So like, for example, it would read, the borrower represents and warrants, it would read the borrower represents and warrants that they're in compliance with all applicable federal, state, and local laws and regulations, right? This type of accountability ensures that the borrower isn't engaging in anything that is illegal that could jeopardize the loan. And once again, non-compliance can trigger the lender to seek remedies. And that's important. Another representation and warranty provision that's important in the agreement is just something as simple as, the borrower, reps and warrants that the collateral that they're providing is free of any other claims or encumbrances, and the information with regard to the collateral is correct. Okay, and it's a very simple provision, but it protects the lender by ensuring that the collateral is valid and enforceable. And again, any misrepresentation about that collateral could lead to a default and will allow the lender to take legal action or remedies under the agreement. Depending upon the borrower, you also probably want to put in a representation and warranty with regard to the operational integrity of the borrower, right? Because a lot of times, and the lender is ensuring or, to get paid that the borrower is a going concern business, right? So simple things, like the borrower represents and warrants that it's duly organized, it's validly existing, it's in good standing, right? All these things have accountability put upon the borrower to say, listen, that they are legitimate and that they're ongoing and that they are going to maintain their legal and operational status. So if they do not, the lender can have remedies right within the document itself. There are others, reps and warranties, that are super important. One of them that I always like to put in there is about, material changes, right? They have to disclose any material change, right, in their business and in addition to their financial condition, right? So a lot of times people don't think of this. You're lending money because you like the management team, right? You like the current business, so you have this rep and warranty that they have to provide you a disclosure if there's material change as a lender. And if they do not, then again, you have a breach and you can get remedies under the agreement itself. There are other reps and warranties about acting in good faith. And again, it's common to put it in, but it depends upon what state you're in, right? Because some states have good faith requirements just built into state law. Other times they're not built into state law, so you have to write them into the agreement. And then you can also have some reps and warranties with regards to condition precedent, right? So, you don't have to give money right away, right? You can have some condition precedent, meaning that, they have to prove certain things to be true before different tranches of the loan are distributed, right? And again, this ensures that the borrower meets some initial conditions, making sure the borrower is accountable, mitigating risk to the lender.
Yeah, that's great. As a lender, we typically kind of skim through the reps and warranties section,
I know
but
you do. I know.
to your point, there's so many key elements in that part of the legal contract that the borrower should be very familiar with, and we should as well. Let's move on from this talk of kind of risk management from a legal perspective and on Sean, how should lenders rethink their risk mitigation strategies in response to global market disruptions? Basically, speaking to the tariff trade war that's happening in front of us.
Yeah, great question, Cole. I think it's imperative, without saying, that businesses continually assess the economic landscape, both locally and globally, to gauge the potential impact on their business operations, revenue, and overall profitability. And as you said, the hot topic at the moment, the topic du jour is tariffs, right? And as we all know, our president refers to tariffs as one of the most beautiful words in the dictionary. But for business leaders and CEOs, they may see it more as a headache, right? Realistically speaking. So it's been a lightning rod globally, and I know markets, they've been, obviously a bit volatile over the past couple of weeks in reaction to the tariffs and the different changes and updates and trade deals that have kind of been struck between the different, different countries globally, particularly the U.S. and other countries such as the U.S. and China. But this is something we were monitoring, from even towards the end of the year, 2024 going into 2025, because the talk was there, obviously, and the change in administration. We knew this was something that was potentially coming. And I think we positioned ourselves fairly well, in terms of assessing which clients may be impacted, right? And to make, the necessary sort of changes, to lending facilities, et cetera, right? And I think embarking on new deals and with new potential clients, it's definitely something, we're keeping front and center. You want to gauge that impact potentially, to the business, to their activities, to their profitability, right? And how much of that is being impacted by the tariffs, before we also ultimately can make a lending decision. And I'll just add to that, in addition to obviously having great partners in insurance and legal and getting the right insurance coverage and having all the right legal contracts and covenants, I think, with that being said, if Goba doesn't necessarily feel too confident or comfortable about a deal, given the tariff implications or other factors, we may still choose to walk away from the deal. So definitely a relevant topic and something, we continue to monitor. And I think globally, a lot of businesses are kind of planning around this to be able to, to mitigate it and kind of navigate these somewhat turbulent waters.
Todd, I'm curious to hear your thoughts on how lenders can improve or beef up their insurance policies to weather a volatile market or a downside scenario.
I don't know what you're talking about with volatility. Everything's very normal these days, isn't it?
Very, very normal.
Yeah, exactly.
Like 2020 all over again, right?
Exactly. So, yeah, it's interesting because, part of credit insurance being a risk mitigant is also the carriers help our clients avoid risk, avoid situations that might turn bad overnight. So, with that being said, underwriters are consistently reassessing risk, their appetite on a, let's say, industry basis, at a country basis, but also at an individual obligor basis. And because of that, lenders do need to be equally nimble, just because like there might be a shift in appetite in any certain, particular sector or country, which would have a devastating effect on the lender. And, we had a situation recently, especially with a lot of the China. It has nothing to do with tariffs. It just had a lot of the political posturing between the US and China, where we had a client, and this was a political risk policy in the technology industry, where we had a very large limit in China where we had to substantially reduce it. And when I say large, we're saying a number that, had a B on it, not an M in terms of exposure. And we literally had to reduce that by more than 50%. And even that, the price went up significantly. Now, that wasn't necessarily used for financing, which it could have been, but this was just straight political risk insurance for this particular client. but that could have had a detrimental effect on any part of the credit facility if there's any term loans or anything else that was where some of those assets were being leveraged or used as collateral. But during any sort of like systematic shock, potential trade war that comes goes, we still don't know what's going to happen even with this 90-day clause. We saw the recession, COVID-19, as you just mentioned, 2020, and right now I think it's fair to say that regardless of what has happened over the last 7 days, we are in some sort of geopolitical crisis. Maybe not true crisis, but just total chaos. No one knows what's really going to happen. And because of that, we're seeing this increased scrutiny on counterparty risk, on the different concentration risks, on sovereign risks. And, because of that, certain countries view certain areas and certain industries very, very differently. So where we might be working with a particular lender here and hitting up the North America market for a certain region across the globe, that lender might gain much better engagement and appetite from a carrier in Europe. I'm dealing with that right now on another situation where we've gotten 20 declinations here in the United States because the risk sits in the Middle East and Africa. Now, this is a multinational company, so then we tapped into the multinational network of our organization, and we were able to find a solution for them I was shocked when I saw the terms and conditions that came out of the carrier. And this was a very well-known, strong brand name, well-rated insurance company. So having that open-mindedness to diversify coverage across geographies, across different markets, and when I say markets, meaning carriers, I think is important to ensure that the banks have what they need and aligns with their current risk profile.
Dina, similar question. How should credit agreements be structured to handle market volatility and potential economic downswings or disruptions?
Yeah, sure. Happy to talk about that. But I just want to follow up a little bit on what Todd and Sean were saying from the legal side. So,
of course,
there is a lot of legal uncertainty. We were just talking about that with tariffs and different things and changes in laws. There are provisions that you can put into loan agreements or credit facilities that do account for change in law. It sounds, well, it does what it sounds like, right? So it says if there is a change of law that would impact the agreement between the parties, it could be as simple as, the parties will come back to the table and renegotiate the agreement in good faith, right? So there are protections that you can put into contracts and loan agreements for these types of changes in law. And one of the things that we're seeing today are changes in law, not only with regards to tariffs, but changes in law with regard to some sustainable commodities, such as like carbon allowances and carbon credits, and that those types of, Todd shaking his head again, those types of things that were collateral for a loan, right? There are now changes in law. And if you had a very well drafted credit facility, you had a provision in there that allowed you to come back to the table given the change of law that could affect that underlying collateral. So it's super important to have that provision in your agreement. So that just went back a little bit, Cole, to talk a little bit more about that change in law and the impact on the agreement. But now to your question about market volatility and economic disruptions and what can you do from a legal side. So, there are lots of things you can do, right? But for the most part, you just got to be flexible and you have to make sure that the provisions that you draft allow for you to dynamically manage your risks, right? And that requires some really good drafting. Some examples here would be, you incorporate a flexible interest rate structure, right? So you use an interest rate mechanism that can adapt for changing market conditions, right? So, for example, you would say something along the lines of, this loan bears the interest of a variable rate of blank. You name your interest rate you want plus some sort of percentage per year that you're going to adjust quarterly. And in the case of significant market disruptions, the rate is going to be reviewed and adjusted mutually by both parties, right? That's pretty flexible. And the benefit of doing that is it allows the lender to adjust the interest rate in response to market volatility and protect against rate fluctuation. That's one example. So you also should build in flexibility into your covenants, right? Remember I talked earlier about what a covenant was. So, you can literally have a covenant that can be adjusted based upon economic conditions, right? So for example, you would say, the financial covenant, such as the debt to equity ratio, like I was talking about earlier, is going to have to be reviewed semi-annually and may be adjusted by mutual agreement by the parties or by the lender, however you want to put it, if there are material changes to market conditions, right? The benefit of having that is it provides room to modify the covenants in response to economic disruption. And again, it reduces risks in just technical defaults, like when the borrower and the lender don't want there to be a default, they prefer to stay in the relationship. And this just allows you some flexibility to do that. There's also something called material adverse change clause or a MAC clause, and this allows lenders to take action if there is a significant negative change in the borrower's financial condition or in the borrower's economic environment. Now, I know we talked about earlier, for there to be changes to the financial condition and they don't tell you, right? And they rep and warranty that they're going to keep you up to date as the lender of changes to their financial conditions. This is a little different. This is, would allow the lender to take action if there's something like I was just describing as a material adverse change, right? So if you write this material adverse change provision and you include, something broader, like there's a broader economic environmental change that could impact the borrower, or even if you say significantly impact the borrower to meet its obligations, then that is considered an event of a default, or then the parties, have to come back to the table. You can also enhance your collateral and your security provisions, right? So in uncertain times when there's economic volatility, you can require additional collateral or security in times of increased market volatility, right? So, you could say something along the lines of, the borrower has to provide additional collateral if the value of existing collateral under this loan falls under some threshold, right? And you say it would be due to market volatility, or literally you just say under this threshold. You can introduce cash flow sweeps where if they have any excess cash, right, you sweep that bank account to pay back the lender on a more regular basis. You could have force majeure provisions if you'd like, where you say, hey, listen, if it's an unforeseen event, everybody knows that's force majeure, but you define it even further. You say it's an unforeseen event, including an economic disruption that impacts this loan obligation. It's a force majeure, and then neither party is going to be liable. Now, again, that's a little bit harder, I think, for a lender, because I think it does and it would temporarily reprieve the borrowers from paying back the loan, but it is something you can put into an agreement, and it does allow for some flexibility in volatile times. There are liquidity covenants and use performance-based covenants, and the list goes on and on and on about what you can do in an agreement in market volatility. There is, provisions you could put in about, restructuring, right? So you would say, hey, listen, we implement right now, today, in this market, procedures to restructure the loan if there is an economic disruption, and you define what that is. And that's also very helpful to mitigate risks in volatile markets. So the tools in the legal toolbox are plentiful, but for the most part, Cole, the underlying theme there is just be flexible, right? Which is what you should be anyway in the loan agreement. But that's just one way to deal with that situation.
Certainly, yeah. I think we pride ourselves here at Goba being flexible, but also very creative when it comes to restructuring the credit or getting back into a more um, commercially flexible arrangement with both our clients and ourselves. So let's move into the last section of the program, proactive risk mitigation for lenders. Todd, as we look to the future, how do you see insurance products evolving to meet the needs of lenders?
That's a really good question. What we've seen recently, and it's also accelerating, with that said, is the lenders are becoming much more sophisticated and a lot more demanding on how they use credit insurance, right? So it's not plain vanilla anymore. It's not a receivable purchase program or a single obligor or simple factoring or SCF transaction, or even not that it's simple, but a straightforward project finance transaction. Now you're seeing banks coming to us looking to structure portfolio solutions, but across different asset classes within a single policy, which is not the easiest thing to sometimes pull off, just given some of the carriers and their mandates in terms of what are they, a trade credit insurer, are they a non-payment insurer, are they a project finance insurer, can they do carbon credits, can't they? But now banks have this whole suite of products that they're trying to get some risk mitigation coverage on, utilizing credit insurance. So both the brokers and underwriters are opening their minds, becoming more flexible to try to structure these types of transactions. So while there are these new challenges for these insurers, the good thing is it's forcing people back, as I mentioned before, to collaborate that much closer from day one. So it's not just the underwriter, it's underwriting, it's claims, it's the risk teams at the carrier, it's the lender, it's the broker, it's the legal teams that are representing each. There really needs to really just become a breakdown in the silos that have been worked through in the past and work in a way that reflects how the bank really sees this strategy holistically for these type of really creative transactions and not just by the product line, right? So when you look at the lender and really questioning, okay, well, how much support will they get from the insurer? That really depends on the nature of the relationship, right? Like some banks look to the insurer as, I have one thing past due, one day, give me my money, right? That's rare, right? So some of the mitigants that Deanna talked about regarding being flexible with wording, the insurer and the bank and the legal teams will work together as true partners to basically try to tie, if there's a repayment scheduled or a repayment aspect to a particular transaction, that the insurer follows that repayment plan and not necessarily have to pay day one because it's past due, but work closely together to make sure that the claim trigger now is if they default on that repayment plan. And there's a lot of different other examples I could use there, but it's not just a transactional contract. It's not just a transactional relationship. And when you see that more partnership, you'll see much more flexibility by the underwriter. And being an underwriter for close to 30 years, I could tell you that that's absolutely the case. It's not just about the amount of premium being spent. It's really about how the bank looks to the underwriter and how they're actually going about doing the day-to-day when things just don't go always as planned.
Right. Dina, as laws and regulations change, should lenders re-engage their counsel to rework the credit agreements?
Yes. So let's talk about something near and dear to my heart. Some regulatory changes can create opportunity for lenders and borrowers. And again, something near and dear to my heart is the digitization of assets, which means you can have digital collateral and blockchain technology that is now being used in credit agreements, or maybe it's not, or maybe you'd like it to be as a lender. And with some regulatory changes, it may be more and more prevalent or coming more in the near future for lenders to do these types of things. Listen, blockchain technology will allow increased transparency and security for both the lender and the borrower, right? So you could put your agreements on there, your collateral on there, right? And then your blockchain is immutable, right? So all your loan distributions, repayments, collateral transactions, they're all recorded on the blockchain. So it's completely transparent and secure. And this just reduces risk of fraud and errors and just make sure that all parties have access, to a reliable tamper-proof record of their transaction. So any kind of regulatory change or shift with digital assets and blockchain technology in use by lenders and borrowers could be a good thing. And that could be coming in the very near future, right? We can also see with these changes in regulations with regards to crypto and stuff that maybe we're going to get some smart contract automation with our lending agreements, right? So smart contract automation will allow, automate the execution of some of the agreement terms, or automate, payment or covenant monitoring, right? So again, I just like to give examples because sometimes I feel like I'm talking and you don't know what it is. So like, for example, you can say, this agreement will be implemented through a smart contract on such and such blockchain, automating, automatically the interest payments and collateral adjustments based upon some predefined conditions, right? So it's automatic. You don't have to worry about it. And then this enhances efficiency and it reduces administration costs to the lender as well for these like routine tasks, which is something that's super cool that could be coming down the pipe, right? Listen, digital assets you're beginning to see a lot more and more now of digital assets such as cryptocurrencies and tokenized commodities being used as collateral for loans. Right. And so, if you're going to pledge some sort of, digital asset as collateral, right, you can monitor the value of that collateral just on a regular basis very easily, right? Because it's digital, and again, this provides some massive amount of liquidity and flexibility that we probably don't have with other types of asset classes outside of the digital assets. There's so many wonderful things that you can do with a changing in regulation with regards to digital asset and blockchain that would affect and benefit both the lender and the borrower. And so you can see all these things coming and changing the financial landscape, which is super neat. I mean, you can do things like, goodness, you can have automated dispute resolution, right? Like you can build in a smart contract that says, listen, here are the mechanisms of how we're going to manage disputes. So in the event of a dispute, the smart contract like triggers, right? And you immediately go to an arbitration process with preset rules and all the documentation, everything that you need is in the blockchain. How cool is that? How much time is reduced? How much cost associated with that is reduced, right? And this is something that's just, I don't know, just thought of it just now, one of the benefits from the changing landscape and regulation, which may change the financial landscape. But there are so many others. That one just happens to be near and dear to my heart. And I see a lot of benefits there and a lot of change coming. And I love to talk about that sort of thing.
Yeah, it's a great example. And I think you just helped us discover our next topic for the next podcast. So thank you.
You're welcome.
Okay. And Sean, looking forward, how should risk managers prepare for future challenges and what steps can they take to proactively protect their loan portfolios?
Okay, excellent. Great question. And let me just comment on what Deanna said. I totally agree. Blockchains and cryptocurrency, just the wave of change and the implications for the global economy, whether it's liquidity or smart contracts, et cetera, transparency. I think we're just scratching the surface here. So definitely yes, a great topic potentially for the next podcast. Okay, so I'm sorry, Cole. Getting to your question, in terms of how we can prepare for future challenges. Well, one thing we can do is get a magic crystal ball, but obviously we don't have all that, right? No one has that, right? So I think preparing for the future, one of the main things any good risk manager needs to do is to be proactive and to monitor the economic environment, monitor business conditions, and to always look ahead and take a look at the aspects of the economy or market conditions that can impact your operations, right? So you need to stay on top of industry trends. You need to monitor, what's going on in the economy, both locally and globally. You need to take a look at the business needs, right? And in factoring all of that into your overall processes, you can go ahead and then make relevant adjustments to product offerings. You can maybe tweak your lending standards, your underwriting criteria, et cetera, et cetera. And obviously, you need to have the right partners in business, whether it's your partners in legal or in insurance or in technology. I think having the right partners is absolutely critical. And also, the employees of an organization, I think, are its greatest asset. So that's super critical too. So I think once you have the right employees and that they're committed to the success of the organization, I think that positions you better and it helps you deal with any potential unexpected situations or economic turbulence that may arise. So those are some of the things that kind of come to mind in terms of dealing with the future.
Totally. Great points. Well, we're coming up on the hour. Wow, time flies by when you're having fun. Deanna, Todd, Sean, thank you so much for sharing your thoughts today. And to our listeners, thank you for joining us for this episode of Let's Talk Success. If you found this discussion valuable, be sure to subscribe and stay tuned for more insights. Thanks again for everyone's time and have a great week. Take care.